Welcome back to the Deep Dive. Today we're jumping right into the Synaptics Q1 Fiscal Year 2026 conference call.
Which was held back on November 6th.
Right, and this one is so important because Synaptics isn't just, reporting another quarter. They are deep in the middle of this massive strategic pivot.
A seismic pivot, really. They're trying to aggressively shift their entire business away from those legacy human interface chips.
And move toward the high-stakes world of Edge AI and these integrated IoT solutions.
Exactly. They're positioning themselves right at that intersection of embedded processors, wireless, and sensing. So the mission for us today is to really unpack a paradox.
A paradox, yeah. Why did the market react with so much skepticism? I mean, the stock got hammered.
It did. And that was despite them delivering what looked like strong execution in their core growth engine and beating the headline estimates. That's what we need to figure out.
Okay, so let's start with those headlines because on the surface, they delivered. The non-GAAP EPS was $1.09.
Which is a formidable number. That's a 35% year-over-year increase. And it comfortably beat the street estimates, which were somewhere around $1.06, maybe $1.08.
And revenue did the same thing. They brought in $292.5 million.
Yep, 14% year-over-year growth there. And just a little bit ahead of the $290 million the street was forecasting. So operationally, a beat.
By their preferred metrics, at least. But now we have to talk about the elephant in the room.
The GAAP results.
The GAAP result. Because while non-GAAP looked great, let's say the full picture, it showed a loss. GAAP EPS was a loss of 53 cents a share.
And that right there is the core of the market's skepticism. It's almost entirely driven by these really heavy non-cash charges that we have to dissect.
Okay, let's break them down.
First, you've got $35.5 million in acquisition and integration costs. So that's just residue from past deals.
And the second one is the big one for tech companies, stock-based comp.
A very big one. $36.7 million in stock-based compensation, or SBC. And for anyone listening, this is a real concern for investors because it dilutes ownership, even if it's not a cash expense.
Right. It's how they pay their engineers to execute this pivot, but the market sees that $1.53 loss and it sees inefficiency. It clouds the whole profitability story.
It does. And the market's reaction was immediate and pretty brutal. Despite the beats, the shares closed down significantly the next day on heavy volume.
It's a classic show me story. The market is basically screaming, we see the growth, but we don't believe you can do it profitably on a GAAP basis yet.
And we don't believe the timeline.
Exactly. Okay, so let's set that aside for a second and focus on where the pivot is working. The engine room, the Core IoT segment.
I mean, that 74% year-over-year growth is it's staggering.
It really is the standout highlight.
And it now makes up 35% of their total revenue. Management made a huge point of this, saying the portfolio has averaged over 50% year-over-year growth for 7 quarters straight.
So this is not a flash in the pan.
No, this is structural growth. And it's really broad-based, which is key. It's not just one big customer. We're talking cameras, point-of-sale systems, wearables.
They're selling full solutions, not just single chips.
And that's how they're capturing more value. Crucially, the margins seem to be holding up too. Non-GAAP gross margin was 53.2%, basically flat.
Which is pretty incredible with that kind of growth. But let me challenge that for a second.
Okay.
Shouldn't they be sacrificing some margin right now if you're growing that fast? Shouldn't you be spending aggressively to really dominate the space against, the Broadcoms and the Qualcomms?
That's a fantastic point. Are stable margins a sign that they're not investing aggressively enough? Their non-GAAP operating margin did improve to 17.6%, and they generated over $30 million in cash flow.
So they're disciplined. They ended with almost $460 million in cash. But yeah, maybe the market wants to see hyperscale, not just cash discipline.
Well, if we want to talk about the future and what unlocks that next phase, we have to talk about their Edge AI roadmap.
Centered on the Astra platform.
Exactly. They just launched the next-gen Astra SL2600. These are their multimodal Edge AI processors.
What does multimodal mean in this context?
It means it can handle complex AI workloads using different kinds of data, like audio, vision, and other sensors, all at the same time, right on the device, without talking to the cloud.
And they said it's already sampling with lead customers.
And they have design wins. That's a critical proof point for the technology itself.
Okay, but let's get into the timeline, because this is where that market impatience really comes into play. When does this actually turn into revenue?
This is the headwind. We're looking at a 12 to 24-month lead time. The first revenue from this new after chip isn't expected until the second half of calendar 2026.
The second half of 26. And what about their most advanced integrated product?
The really complex stuff. The ones with the MCU, Wi-Fi 7, and Bluetooth all on one chip. Those won't even sample until the second half of 26, which means revenue doesn't start until the second half of calendar 2027.
So you're asking investors to wait potentially 2 years to see the full validation of this pivot.
And that explains so much of the hesitation. But what's their big differentiator? Why would a developer choose Astra over, say, NVIDIA or Intel?
Their strategic bet seems to be on open source.
Right. It's a gamble. They have this partnership with Google to integrate the open source Coral NPU accelerator. They're trying to make it way easier to develop AI applications for the far edge.
Which is counterintuitive, isn't it? I mean, every other giant is trying to lock customers into their own software.
It is. But I think it's a speed play. For smaller IoT device makers, navigating a huge proprietary stack like NVIDIA's can be slow and expensive. Synaptics is betting that by being open and easy.
They can get developers to prototype and deploy faster.
Exactly. They're going for market breadth and rapid adoption, maybe sacrificing a little bit of that high-end performance control to get it.
That makes sense. Okay, shifting to the rest of the business. Enterprise and auto is still a heavyweight at 51% of revenue.
Yeah. And it's a mixed bag. The enterprise PC business is actually doing well. They're gaining share there. But auto demand is still soft. And that hurts.
Because auto is typically a higher margin business.
It is. So that softness creates a drag that the IoT growth has to work even harder to overcome.
And then there's mobile touch, only 14% of revenue, and it underperformed because of supply issues.
But there's a huge potential catalyst hiding in there.
The foldables.
The foldables. They have new design wins for touch controllers in foldable OLED phones. And management said the silicon content for them is more than twice what it is in a normal smartphone.
So if that market keeps growing, that's a significant high-margin tailwind coming in the next fiscal year.
Absolutely.
Okay, so let's look at the guidance for next quarter, Q2. Where are they pointing the ship?
They're guiding revenue to a midpoint of $300 million, which is about 12% year-over-year growth.
And what about margins?
Still holding strong. Non-GAAP gross margin is guided slightly up to 53.5%, and non-GAAP EPS is expected around $1.15. So that profitability story, on their terms, continues.
And the mix shows a slight moderation in IoT growth, but a nice recovery in mobile.
Which just reflects those supply issues easing up. So the guidance is, it's solid, it's stable. But it's not the explosive growth that would make the market forget about the gap losses.
Which brings us right back to the stock. The underperformance gap here is just so clear.
It's stark. The stock, SYNA, is down about 13% in the last year, while the main semiconductor ETF, SOXX, is up around 26%. The market is just betting against their timing.
And it really boils down to three things, right? The JAP losses from SBC and acquisitions.
The softness in key segments like auto.
And that long 12 to 24-month wait for Astra to really start kicking in revenue.
Yeah. And you can see it in how the professionals are positioned.
High institutional ownership, close to 99%.
You have huge short interest, about 8% of shares, and a really high put-to-call ratio, around 1.4. That means people are actively hedging or just betting on more downside. This isn't passive skepticism.
Before we get to our trade idea, we have to mention one more thing. A really smart partnership they announced.
The Qualcomm partnership. This is incredibly smart. They're combining their touch controllers with Qualcomm's ultrasonic fingerprint sensors.
Which gives them leverage into the AI PC refresh cycle.
And into premium mobile phones. Without having to spend billions developing their own application processors, it's a huge validation of their core tech.
It changes their role from just a component supplier to a real platform partner.
Precisely.
All right. This is not financial advice. We're looking at a classic dichotomy. You've got amazing growth in the core IoT business and stable margins.
Pitted against this wall of market pessimism that is almost entirely about timing risk and that gap overhang.
So if you believe management, if you believe the Astra roadmap is real and that IoT growth will continue,
then the market is just excessively discounting the value of that revenue that's coming in 2026 and 2027.
So let's pitch an outrageous but plausible trade, one that tries to capture that valuation gap.
Okay, so the idea is to go long, but not by buying the stock directly. You'd use long-dated, deep-in-the-money call options.
Okay, break that down. Long dated, so expiring when?
Late in calendar year 2027. You're basically giving the company 2+ years for the Astra story to play out and be reflected in the numbers.
And why deep in the money?
A deep-in-the-money call acts a lot like owning the stock, but it gives you significant leverage for a smaller upfront cost. And by going so far out in time, you minimize the damage from short-term volatility and time decay.
So the bet is simple.
The bet is that by the end of 2027, the Astra execution will be undeniable. The revenue will be there. And the market will be forced to re-rate the stock from a legacy component vendor to a premium AI solution provider.
It's a high-conviction trade that accepts that long waiting period in exchange for potentially massive upside.
You're betting on management's ability to execute over that 24-month chasm.
So to wrap this all up, the pivot to Edge AI is real. It's delivering tangible, high-growth results in the Core IoT segment right now with good margins.
No question. The operational performance is strong. The headwinds are that gap overhang and the long roadmap for Astra, which is what's fueling all this investor skepticism.
But let's end on this thought. Management talked about the massive scale of this far edge opportunity. We're talking industrial robotics, AR glasses, next-gen wearables.
An enormous addressable market. And they project their revenue stream there will accelerate dramatically over the next 2 to 3 years.
So the provocative question we want to leave you with is this. Does the current stock price, which is so weighed down by near-term noise and non-cash charges, accurately reflect the potential of that future revenue stream? A revenue stream they are actively winning designs for today.
That's the challenge and the opportunity for anyone looking at this company.
Thank you for joining us for this deep dive. We encourage you to continue exploring the catalysts ahead.